So we are going to continue on today talking about chapter 5. We've got 4 more days, including today, scheduled for chapter 5. I'm hoping actually that maybe we get finished with it a little bit early. We can start talking about chapter 6 and get an extra day in about chapter 6, our final chapter about those journal entries. And we've got review for the comprehensive exam, your final exam, and holy cow, it's almost December. Hard to believe. Any questions right now before we get started? All right. So let's continue on. So we got a little bit of an introduction last week on federal unemployment tax and state unemployment tax. We're going to get into some calculations today and a little bit more detail about how it all fits together and how it works. And we ended last time we were talking about interstate employees, those employees who may work in multiple states, and how we determine which state unemployment tax system they fall under. And remember, we had those 4 different factors that we had to look at, and we would look at them in order to determine where exactly they should fall. Now, there's always the possibility that even after looking at all 4 of those factors, we may not be able to determine exactly which state they fall under. So there is, pull up my slide here, sorry. So employees and employers can come to an agreement as to which state the employee is covered under if by going through all 4 of those factors it's still undetermined. Again, it has to be approved by the state as well. The state gets to choose as long as the employee understands and consents that this is the state under which they are going to apply those rules. Of course, there may be some disagreement between the employer and the employee as far as which one is most beneficial. The employer naturally is going to want to be covered under that state that has the lowest tax rates, whereas the employee may want to be covered under that state that has the greatest benefits. Now, those 2 things aren't necessarily exclusive of each other. But there is this agreement that employers and employees can come to, provided none of those 4, it cannot be determined using those 4 other factors. Now, if an employee is transferred to another state during the same calendar year, the employer can count those wages against the limits in the new state because they're working for the same employer. Now, if the employee had changed employers during the year, then it would be as if they started all anew. But if it's the same employer, then the employer can count those wages that were earned previously. So, for example, if an employee works at Walmart in Iowa and then they transfer to another Walmart in Illinois, they earned $10,000 while they were in Iowa, the employer is allowed to credit those $10,000 that they've already paid under Iowa law toward the Illinois maximum. Okay, so there is that ability, but it does have to be with the same employer. So if the employee works at Walmart in Iowa and then moves to Illinois and works at Target, when they start working at Target, it's as though their earnings start all over again, and the employer is not allowed any credit for that. Any questions so far? All right. So Americans that are working overseas, these are and we're talking about Americans who are working for U.S. employers. If they are not working for a U.S. employer, then they may or may not be covered by unemployment depending upon where they're located, what the rules are in that particular jurisdiction. But if they are covered, if they are working for an American employer, then wherever the employer's principal place of business is located in the US, that is the state under which that employee would fall. So for example, if you're working for Coca-Cola, which is their headquarters are in Atlanta, Georgia, but you're working for Coca-Cola in London, England, you are, as an American then, you are going to be covered under the jurisdiction of the state of Georgia as far as unemployment taxes are concerned. Okay. If, again, the principal place of business cannot be determined, then second up would be the state of incorporation, which oftentimes is not necessarily the state where the operations are, but the state of incorporation, or if it's a single owner, wherever that owner's state of residence is, that's where they would fall under. Okay. Employees, in order to qualify for benefits, and this is kind of an area, we don't really talk a whole lot about the benefits, we're just really concerned with how the taxes are collected in order to pay those benefits. But in order, just to kind of give you a little overview, in order to qualify for benefits, those individuals who are claiming benefits from unemployment have to have earned a minimum wage amount during a certain set period of time. So you can't, and it would vary from location to location, from state to state, what those rules are. But for the most part, so you can't like start a job at Fairway and then work there for a week and then you don't claim. I don't mean to pick on Fairway. I know we were talking about Fairway last week. And then like a week later, you only work there a week. You really don't have any, that base period isn't long enough in order to claim any benefits at that point. And again, so there are lots of other rules state by state. Let's see. Questions about all that. So we've talked about how the FUTA and SUTA system kind of work together. We've talked about what employers are covered, what employees are covered. Now we're going to talk a little bit about what wages are covered. So we talked about this as well when we were discussing Social Security and Medicare tax and income tax. What kind of wages are subject to these taxes. Well, for FUTA purposes, we have, just like we had with Social Security tax, we had a wage base. So only the first $147,000 of income was covered and was taxed under Social Security. We have a wage base for FUTA as well. That wage base is much lower. It's only the first $7,000 of wages. Now this is the first $7,000 per employer per calendar year. So that means that if I work, let's say I work for DMAC for half of the year, and then I work for Iowa State for the other half of the year. Well, DMAC is going to have to satisfy that $7,000 wage base, and then Iowa State would again have to satisfy that $7,000 wage base. So really, $14,000 of my income would be subject to tax, $7,000 for each employer. Now remember, with FUTA, the employee is not paying any amount of that. That is only the employer. So the first $7,000 of wages per employee, per employer and per employee per calendar year. Okay, so it's possible if somebody has 10 different jobs and they make over $7,000 at each of those jobs, that $70,000 of their income is going to be subject to FUTA tax because they have 10 different employers, right? Or it's possible if you have one employer during the year, only that first $7,000 is going to be subject to FUTA tax. So does that makes sense to everybody? It is on a per employer basis. So a little bit different from Social Security tax in that regard, because remember that 147 wage base is per employee or per taxpayer per year. It's not per employer per year. In this case, it is per employer as well. Okay, so the same types of wages are also that we're also subject to Social Security and Medicare tax in determining determining those taxes as well as the income taxes, same types of wages apply here. So salaries, bonuses, hourly wages, commissions, those types of things. Retroactive wage increases would be included in that. Tips as well would also be included. Transfer of stock by employer to employee. So if the employee is eligible for incentive stock options or things of that nature, or the employer, instead of paying them, in lieu of paying them some amount of salary, is giving them stock, the fair market value of that would still be considered wages for purposes of FUTA. So all of those, pretty much all of those same types of wages, salaries that we've talked about before, would also be considered wages for FUTA purposes. Yeah.
So anything you make after the first 7,000, there's no FUTA or SUTA?
For that employee, well, SUTA is different.
Okay.
We're just for FUTA. This limit, this $7,000 limit, is only for FUTA. Okay. And it's, again, so it's per employer. Okay. So yes, as long as you only made that 7,000 for that one employer. But then if you switch to another employer, that new employer is going to have a $7,000 limit on your wages as well.
Okay.
Does that make sense?
Yeah.
And we'll do some problems to illustrate that as well. Non-taxable wages, advances or reimbursement of any business expenses. So all of those reimbursements that we talked about with regard to accountable plans, those would not be considered taxable wages for FUTA purposes, just like they were not taxable wages for Social Security, Medicare, and income tax purposes. Retirement pay is not, and this one's kind of funny, because retirement pay is something that you receive after you no longer work for an employer, but any amounts of retirement pay, pensions, IRA distributions, that sort of thing, even though you earned that while you were working, it's not counted toward the FUTA limit. Educational assistance payments to workers, so that would be any like tuition reimbursement up to the $5,250 that we had talked about earlier, or any job-related types of education. Again, meals and lodging for the employer's benefit. So that's that we still have that distinction between whether it's for the employer's benefit or the employee's benefit. If it's for the employer's benefit, it's not taxable, not considered to be wages for FUTA purposes. Strike benefits paid by a union to its union members are also not considered to be wages, and there's a lot of others as well. But questions at this point before we get into some of these calculations? I'll show you how all of this works. Okay, so again, we are only talking about FUTA right now. We will talk about SUTA, but this is, and so there's two different taxes and two different sets of rules. Actually, there's more than two different sets of rules, because each state has their own set of rules for SUTA purposes. But we'll go through and we'll look at what Iowa is as we get as when we start talking about SUTA. Okay. So the tax rate for FUTA is 6%, but it's only on the first $7,000 of income. Now, in addition to that, though, we have what's called a credit against FUTA tax, against the percentage. This is where it gets a little bit weird. This credit is a maximum of 5.4%. They use it in percentage. It should just, I don't know if it should be represented as 5.4%, but so our maximum rate is 6%. Our maximum credit is 5.4%. So 0.6% is our minimum FUTA rate. If we we subtract that maximum from the maximum, we get a minimum FUTA rate. That means that the lowest rate that any employer is going to be paying for FUTA tax is 0.6% on income up to $7,000. That's $42, FYI. So $42 per year per employee. Okay? Now, this credit isn't always 5.4%. The credit can be reduced. And this is where it gets a little bit, the wording on it gets a little bit tricky, because we hear that word reduced, we think reduced tax rate, we think that's a good thing. In this case, when you've got the credit that's reduced, you're actually going to pay higher tax. So, for example, if you've got if we've got our employer has a credit reduction of, let's just say 1%. Their credit is reduced by 1%. That means instead of 5.4%, it's going to be 4.4%. So now we're at 1.6%. So our tax rate has actually gone up. When you have a credit reduction, it means that the tax rate is going to go up. Okay? Like I said, the lingo on this can get a little bit confusing, because it's, I don't know about you, I think of anything when I'm talking taxes and I think of a reduction, I think that's, hey, that's more money in my pocket. Not necessarily. In this case, it's just that credit that is being reduced. So, most employers will get this full maximum credit. But like I said, there are times when it gets reduced for certain employers or for employers of certain states. And I'll go through and talk to you a little bit about, the next slide or not, when that happens. Yes, I think up here. Okay, so what we're mainly going to be working with as far as a percentage is usually 0.6%, but you do have some problems where you have to account for a credit reduction. Okay. Questions about that? Okay. So in order for employers, sorry, remember this is only for employers, to get that maximum credit amount, they have to meet certain criteria. One of those criteria is they have to pay their SUTA contributions, their state unemployment contributions, those taxes, on time. Now, like I had said before, the state unemployment tax systems and the federal unemployment tax work in conjunction with each other. Sometimes the federal government has to step in and help to finance the state unemployment benefits. And when that happens, employers in those states can be penalized, or employers that didn't make those payments on time can be penalized. They're penalized by reducing this credit. So first thing, they've got to pay their SUTA taxes on time in order to get that maximum credit amount. Another thing that they have to do, I'm going to come back to this other one. Another thing that they have to do is they have to be lucky enough to be in a state that doesn't owe money to the federal unemployment tax system. So if the state, what happens is Social Security will lend funds from the federal government to states so that they can pay those unemployment benefits. So if a state runs out of money and can't pay unemployment benefits, the federal government will step in and they will make good on those payments on behalf of the state. Well, that means the state owes the federal government money because they haven't managed their state unemployment system well enough to be able to fund their own system. So when that happens, the federal government again penalizes them by reducing this credit. What that does as well is it helps to make those payments and get them current again. I think that I don't know if there are any states right now. Let's see. This one's a little bit old. Talking about California, Connecticut, Illinois, New York, and the U.S. Virgin Islands may face a FUTA credit reduction for 2023. Of course, we're almost done with 2023. Let's see if there are any current states. This one just says they're at risk, and this was so what happens there is that employers then have to pay more in taxes when the state doesn't have enough in their coffers to make those benefit payments to individuals. That makes sense? I mean, that's the reasoning behind this reducing this credit, which effectively increases the tax rate for employers. Okay, so like I said, even if you as an employer, you made all of your payments on time, if the state itself hasn't been able to keep up with its benefit payments and the federal government had to step in, the employers are the ones that have to make those payments. Okay, let's see. It just says they may face, but I don't know when that's actually determined. List of potential FUTA credit reduction states for 2023. These states already have a credit reduction of 0.3% for 2022 and may face a further credit reduction of 0.6% for 2023. U.S. Virgin Islands also faces a potential credit reduction of 4.8%. So that means, again, employers in the Virgin Islands have to make up the difference. They're the ones that are going to be penalized. Let's see. So the credit is reduced 0.3% per year beginning the second year after the advance. So this is when they've advanced the funding. It'll be reduced by 0.3%, but then additional credit reductions are possible beginning with the third or fourth consecutive year in which that federal loan is not repaid. So that's the thinking behind that credit reduction. All right, so let's make up some problems, shall we? Now remember, we have to think of this in terms of from the employer's perspective. Per employee, we have to keep track of how much each employee has made in FUTA taxable wages during the year. And at some point, they're going to may reach that $7,000 wage base. After which point, we don't owe any FUTA taxes on those wages again. So let's just say we have employer A, and we've got 3 employees, employee 1, employee 2, employee 3. And during the year, employee 1 made $6,000. Employee 2 made $12,000. And employee 3 made $7,500. We'll assume that the employer is not in a state with a credit reduction and is not an employer with a credit reduction. So their rate for FUTA would be 0.6%. Be careful with that. So when you're multiplying, it's 0.006, not 0.06. Because you're multiplying by 0.06, it's 6%. So remember, our maximum taxable income is $7,000. So employee one, all $6,000 would be taxable, right? So they haven't reached that $7,000 mark. So 6,000 would be taxable. Employee two, even though they made 12,000, only 7,000 would be taxable. And employee three, even though they made 7,500, only 7,000 would be taxable. So total tax, 20,000 in taxable wages times 0.06, we have $120. All right. I did that in my head. Is that right? So the amount of food tax would be the $120 that the employer pays for the year. Okay, you have a question? Well, yeah, sorry. I should. Percent. How's that? Point. You're right. Thank you. My calculator up. So, $120 in food taxes. That doesn't seem like a whole lot, does it? And it's not. You'll see when we get to calculate. Remember, this is only to pay for the administration of the program. When we get to SUTA tax, you'll see that the SUTA rates are much higher. They're higher in a couple of ways. Most of them have higher tax rates, and most of them, not all, but most of them have higher wage bases as well. Okay, so more income is taxed and at higher rates. But that makes sense, right? Because those are the funds that are actually paying for the benefits. Okay. So, let's see. We have, let's break this up into 4 quarters. Quarter 1, 2, quarter 4. Okay, during quarter 1, employee 1 made $2,000. Employee 2 made $7,000. And employee 3 made $5,000. During quarter 1, nobody exceeded that $7,000 wage base, right? So all of these wages would be subject to food tax, right? So 14,000 in quarter 1. In quarter 2, employee 1 again made $2,000. Employee 2 made $7,000. And employee 3 made $5,000. So now what we have to do is total up we have to get a cumulative amount of wages to determine how much of these wages is going to be subject to food tax, right? So at this point, I don't have a big enough spreadsheet here. So the taxable for quarter 2, how much of this 2,000 would be taxable? All of it, right? Because they haven't reached 7,000 yet. So 2,000. How much of the 7,000 would be taxable in the second quarter?
All of it?
The exact opposite. So they've already reached the 7,000 in the first quarter. In the second quarter, they had another $7,000 of wages. So none of this is going to be taxable. In fact, none of their wages, as long as they stay at this employer, none of their wages for the rest of the year is going to be taxable. Because they've already reached that $7,000 mark for the year, right? So none of it is taxable here. Now, how much of this 5,000 in the second quarter is taxable? What's that? 3,000? You're thinking of it backwards. So, I mean, you're on the right track if you're thinking about it backwards. You're thinking about the amount that's not taxable. So, they were at 5,000 before. They have $2,000 remaining that would be taxable for the year, right? So, for the third employee, only $2,000 would be taxable, okay, to get to that $7,000 mark. Does that make sense? Yes? No? I see a couple of nods. All right, let's get a little more. So we would go on throughout the year. Let's see. So let's do taxable Q1 as well. Kinda out of space. 1, 2, 3. All right. So employee 1 in the first quarter made $6,200. Employee 2 made $8,000. Employee 3 made $2,000. How much of the $6,200 in the first quarter for employee 1 is taxable? All of it, right? $6,200. How much of the $8,000? $7,000. And how much of the $2,000? All of it, right? All right, so 9, 15. So 15,200 in total is taxable. That's the amount then that we would multiply by our tax rate. Now, when we get a little bit further on here, I'll show you how when those amounts are paid. Okay, because we have a whole different payment schedule as well now, possibly. All right, so in the second quarter, let's say that, so at this point, how much more does this employee have to earn before they get to the wage base? $800, right? After $800, there's no more that they won't be, the employer won't have to pay tax on any additional wages. This employee, nothing, right? Because they've already reached that $7,000 mark. Employee 3, how much more do they have to earn before they max out? 5,000, right? Okay, so again, they made 6,200, 8,000, and 2,000. So, how much of that 6,200 is taxable? 800, right? Because we had 800 left to go after the first quarter. So 800 of this is going to be taxable. How much of the 8,000 is taxable? None of it, right? How much of the 2,000? All of it. So 2,800 is taxable. So we have total wages and then we have taxable wages that we have to calculate. Now remember, on the total wages, we're going to have to keep track of Social Security as well, and Medicare tax that's been paid, and income taxes that have been withheld, and all of that. This is a whole separate calculation. So it's kind of a separate spreadsheet that would have to be managed to keep track of how much has been earned for the year. Let's take it one more. Q3, and taxable Q. I know that those of you over there can't see that very well. All right, so we have 8,000 and 2,000. How much of the 6,200 is taxable in the third quarter? The 6,200, the first employee, nothing, right? Because they reached that $7,000 in that second quarter, so none of that is taxable. What about employee 2, the 8,000? Is any of that taxable? Nope, none of that is taxable. What about employee 3? Yes, all of it's still taxable because they haven't reached the 7,000 yet for the year. So we're going to be taxed on 2,000 of that. Let me see if I can find another problem in your homework. The one that's just food and tax. Save this for when we get to the SUTA taxes as well. We'll pull out one of these and play around with it. Okay, so that is how those FUTA taxes are calculated. You keep a running tally of how much each employee has made for the year. And then for each quarter, you've got to determine how much of the income that they earned during that quarter is taxable. Because it's entirely possible that not all of it will be taxable, or maybe not any of it will be taxable if they've reached that 7,000. Questions? All right. Now, if this were obviously, if this were an employer that has a credit reduction, then our tax rate is what's going to change. We're still going to be maxed out at the 7,000. We still have that limit, but let's just say we're now at 1.2%, so we had a credit reduction of 0.6%. Now, the taxable amount's the same, but our tax rate that we're going to use to figure out the tax is different. I guess I didn't take it to that final. So this would be times 1.2% times 1.2% times 1.2%. All right, if there's anything else I wanted to say here. To move on and a little bit ahead of time. Let's talk about SUTA taxes now. So we've got our tax rate for FUTA. We know about the credit reduction, and let me just tell you that credit reduction is what students struggle with the most, is conceptualizing that credit reduction, that it affects the tax rate. And it doesn't reduce the tax rate, it actually increases the tax rate. Okay, so SUTA taxes. FUTA taxes are the same nationwide. SUTA taxes will vary based on the state, based on the employer, based on the industry that the employer happens to work in as well. I had mentioned last week, it's insurance. So insurance premiums are based on risk. The higher the risk, the higher the chances that the insurance company is going to have to pay out, the higher the premiums are going to be, right? They want to collect more money to cover that risk. Even though it's not technically an insurance, it's not insurance companies that are administering this, it's the state and the federal government, it does act like an insurance policy. Okay, so same thing applies. The higher the risk, the higher the premiums. That means that there are certain industries that are going to just naturally pay a higher rate. Those industries that are more prone to unemployment. So think the construction industry. Construction industry, as well as having really high workers' compensation rates, because there's more risk of injury in those occupations, the construction industry also generally pays higher unemployment tax rates because there's more turnover in that industry, as well as the fact that it's a seasonal industry as well. So, and oftentimes when employees in the construction industry don't have work because it's out of season, they will apply for unemployment benefits. So just naturally, those companies that are in the insurance or the construction industry will pay higher rates, as opposed to, I don't know, accounting's a pretty good example. Accounting industry tends to have lower rates of turnover, and so those companies that are in that industry will tend to have lower unemployment tax rates as well. But individual employers also will be assessed their premium rates or their tax rates, because individual employers will also have experience with whether or not there's a lot of turnover or not. So they're also going to be assessed those rates, and it's going to be analyzed on an annual basis by the different states. So let's take a look at Iowa in particular here. I'm going to pull up so we looked at this a little bit last week. This is so difficult to see. In your textbook, you've got this list. So Iowa, the lowest tax rate in Iowa is 0%. The highest tax rate in Iowa is 7.5%. This is for 2022, I believe. 2022, 2023. 2022. We can take a look and see what it is for 2023, but for your problems, we would want to look at 2022. Use the amount, and you've got homework problems that ask you to reference this table. Use the amounts that are referenced in your textbook, not what's current as far as the tax rates go. So Iowa, on the first, where'd I go? 34,800 of income. So we've got a much larger tax base in Iowa, right? All of those employees that we listed up here, I don't think any of them reached 34,800 total for the year, at least yet, through the third quarter. They would all still be subject to unemployment tax in Iowa for Iowa purposes, if that company was in Iowa. So you can see there's two, you've got to do a calculation for FUTA tax, and then you've got to do a separate calculation for SUTA tax as well, because we've got two different wage bases. Now, depending upon the state, some states, let me see if I can find one here. No, maybe there's nobody listed. I'm looking to see if there are any states that have the same wage base. What's that?
Someone had 20% is the higher.
One of them had 20%?
Yeah.
There's a 14.37, 10.5. Some of them can be quite high. Ours only goes up to 7.5. There's a 10.39, 14.2. There we go, 20.93. Who is that? Arizona. Up to 20.93%. There's a footnote here. What does it say? Okay, we'll talk about those voluntary contributions as well. Arizona also doesn't seem to have a wage base, a minimum or a maximum listed here. So Iowa, from 0% to 7.5% on the first $34,800 of income. So let's take a look. Let's see if we still have employer. I have employer B, and we've got 3 employees. And we'll say this is Iowa. And this employer has been assessed, let's say, a 5% tax rate. So quarter 1, and then taxable. Right there, salary is a little bit higher. 10,000, 12,000, and 14,000. Okay. For each of these employees, remember our maximum is 34,800 is our wage base. So taxable, all of it, all of it, all of it. So we have 36,000 times 5%. In this case, the SUTA tax for that first quarter. Oops. 1,800. Now, for FUTA purposes though, how much of employee one's wages would be subject to FUTA tax? For FUTA purposes. So this one is for SUTA. Let's do this. We'll say SUTA and taxable FUTA. How much of that 10,000 would be subject to FUTA tax?
7,000.
7,000. Employee 2, 7,000, 7,000. So $21,000 of wages would be subject to FUTA tax for the same employer. And that tax rate, if they're times 0.06, oops, sorry, did it again, 0.006, if they have no credit reduction, oops, $126. And they'd be done, if there were only 3 employees and that's what they've been paid, they'd be done paying FUTA tax for the year. But they wouldn't have to pay any more. Because those employees, unless they hired a new employee, if they hired a new employee during the year, then that 7,000 mark would start again. That would start, what am I trying to say? We'd have to start calculating that for the new employee as well. Okay? But if we only had these 3 employees and we didn't hire anybody new during the year, FUTA taxes would essentially be done for the year, $126, because any further income would not be subject to FUTA tax. But we would still have SUTA tax because we haven't reached the $34,800 wage base for SUTA tax. Does that make sense? What questions do you guys have? None?
Is the 34,800, that is for the employer, right?
That is, rephrase that question.
So since we have, the employer has 36,000 in taxable SUTA in the first quarter with all 3 employees, they're over that wage base, but that wage base only applies to
That
just
wage base,
employees?
that wage base applies to each employee individually.
Okay, okay.
Yes. When I say per employer, it means if any of these employees work somewhere else, that other employer is also going to have SUTA taxes, yes. That 34.8 is going to apply.
Okay.
So if an employee works for multiple employers, yes, that wage base applies to each employer, each employee. Does that make sense? Okay, so there's our taxable FUTA. Let's do, I'm gonna erase this, and we're gonna do second quarter here. So, quarter 2, taxable. $20,000. $12,000. And $30,000. Alright, so this is the total amount of wages that they earned. Adding these two together for the total wages, this employee 1 is still not to this $34,800 wage base, are they? Right? So all 20,000 would be taxable. None of it would be taxable for FUTA purposes. We're already at that 7,000. Employee 2, total amount of wages for the year so far, 12,000 in the first quarter, 12,000 in the second quarter. So all of that, so we're at 24,000, so all of that 12,000 would still be subject to tax. Now, employee 3. Oh, I didn't do it enough. Let's give them a bonus. They got a bonus. I want them to be over the limit. All right. So total wages that they have earned for the year are 54,000. Right? 14,000 in the first quarter, 40,000 in the second quarter. So they're at 54,000 for their total wages. They are over that wage base. Right? So some of this is going to be taxable and some of this is not going to be taxable. Okay? We can add these two together, so 54,000 minus 34,800. This is how much they are over that wage base, so 200, so we have 4, 9, 19,200, I get that right?
Yeah.
Is what they are over. So this amount is not, this amount of the 40,000 is not taxable because they are over by that amount. So we have to find the difference between the 40,000 and the 19,200. Okay? So, which is, what is this, 40? So this is non-taxable. Minus 19,200. 3, 9, 0, 20. So $20,800 of this $40,000 is taxable. So for SUTA purposes then, 20,000, 12,000, and 20,800, 800 to 52,800 in wages are taxable for SUTA purposes. We multiply that by the tax rate. $26.40. So you'd want to keep a running tally of how much has been paid in total to determine whether or not you've reached that wage base. So for example, employee 1, they were paid $10,000 and then $20,000. So year to date, get this out of here, taxable. Year to date, $30,000. So they've only got another, what, $4,800 of taxable wages. This employee, they've made $24,000 for the year. So they would have another $10,800 of taxable wages. Employee 3 has made $54,000. They're over the base. They're over that wage base. There would be no further SUTA taxes for that employee. Now imagine, if you will, having employees that work in 13 different states and having to track that. That's a lot to keep track of. All right, let's see. I think we've got some problems there that, homework problems that we can take a look at as well. I'll leave this up here for, well, I need space. Let's look at a couple of problems here. Let's go up here. All right, so we've got Plum Company. They have a SUTA tax rate of 4.8%. The taxable payroll, now here they're giving you the taxable payroll. They're telling you how much of those wages are subject to FUTA tax, how much are subject to SUTA tax. Okay, for this textbook edition, the rate of 0.6, let's see, and I think we assume there is no credit reduction. Unless it says there's a credit reduction, assume there's no credit reduction, meaning that FUTA tax rate is going to be 0.6%. So let's take a look at this. So they've got a SUTA tax rate of 4.8%. Taxable payroll for the year is $120,000. So $120,000. And we've got FUTA and SUTA. So 0.6%. And 4.8%. This one's fairly simple to figure out. We're just going to multiply. So $72. Do I have that right? 0.006. That's 120. I think I missed. Yeah, $720. $47.60 in SUDA. And then those added together, 80, was it 64.80? Okay, here, like I said, this is fairly easy. They're giving you that taxable income, in this case, of $120,000. You may have some problems though that give you total income and taxable income, or you've got different taxable income for FUTA purposes than you have for SUDA purposes. Let's see. Let's take a look at this one. All right. Quan Company. So their payroll for the year is $737,910. Of this amount, so this is the total payroll. Of this amount, $472,120 is for wages paid in excess of $7,000 to each individual employee. Be careful, the wording here. What they're saying is, this is not the taxable amount. This is what was paid over and above $7,000 for each employee. We have to figure out how much was paid under $7,000 or up to $7,000 for each employee. The SUDA rate is 2.9%. Again, lucky for us, the state rate is the state base is the same, 7,000. So in this case, let's take the 737,910 minus, and again, this is excess over 7,000 per employee, which means it's the non-taxable portion, 472,120. So what we're left with is our taxable, which is up to 7,000 per employee. 8, 7, 5, 6. So 265,790 is the taxable portion of the wages. Now we've got two different tax rates, right? We have the FUTA tax rate and the SUDA tax rate. So, FUTA tax rate, we're going to take this amount. Now, like I said, it's the same. Our wage base in this problem is the same for FUTA and SUDA. That is not necessarily the case for all of these problems, though. Because like we saw with Iowa, we've got two different wage bases, right? So in this case, though, we're going to take the 265,790 times 0.006, and this will be our FUTA. $115.94.74. And then for SUDA, what's the calculation going to be for SUDA? What's the calculation look like? How much is taxable for SUDA purposes in this problem? So remember, for FUTA, it's 7,000. SUDA, it's also 7,000. That means the taxable wages for FUTA are going to be the same as they were, or for SUDA are going to be the same as they were for FUTA, right? So what are the taxable wages for SUDA? What's our tax rate? 2.9%. 7, is that right? No, 265,790 times 0.029. 770791. And then the total for both of those, we're just gonna add them together. You know how to add. I'm not gonna do that. Let's see if we can get one that's a little more challenging here. Any questions on that though? Okay, this one's a little bit more. Okay, so Garrison Shops had a student tax rate of 3.7%. That's a little bit bigger. The state's taxable limit was $8,000 of each employee's earnings. So now we have a different wage base for the state, right? 8,000 instead of 7,000. For the year, Garrison Shops had food and taxable wages of $67,900 and student taxable wages of $83,900. And this probably, we don't really even need this information about the 8,000 because they've given us the taxable wages, right? But we have two different amounts that are taxable. So for, let's see, they want FUTA first, FUTA. We're gonna take our wage base, well, actually taxable wages in this part, in this problem. FUTA taxable wages, $67,900 times our rate, which is points, there, we're not limited, okay, so 0.6006. And then for SUTA, our taxable wages are different, 83.9 times, and our rate is different as well, 3.7%. $407.40. And SUTA tax. $3104.30. $35,170. Oh, they don't want the total. All right. Okay. Questions about that one? Let's see. This is kind of the same thing. Right now we've got two different states, but it's not one single employee, so we're not talking about any type of credit or anything. But actually we got three states. So under SUTA for Massachusetts, on taxable payroll of $18,000, the contribution rate is 4%. So we've got, well, let's do FUTA first. under FUTA, the taxable payroll is 103,500. So we got 3 different states though for SUTA purposes. Massachusetts, 18,000. And it's 4%. And then we have New Hampshire. Taxable payroll, 24,000. Times 6.65%. And we've got Maine. Is it M? It's not MN. ME? Is 79,000. Contribution rate is 2.9%. Now we can figure those out. So 103,500 times 0.006. Oops, I think I got 0.003. 103,500 times 0.006. 621. Like I said, there's no credit against one state's taxes against another state's taxes in this example, because we're not talking about an individual employee. We're talking about overall, they gave us the taxable wages for each of those. Keep doing some calculations here. The energy company began its operations in September of the current year. During September, the company paid wages of $23,400. For the last quarter of the year, the taxable wages paid amounted to $64,700. None of the employees was paid more than $7,000 this year. Are they liable for FUTA tax? Why they wouldn't be. What is the net FUTA tax for the year? All right, so September, $23,400. The last quarter, $64,700. None of them were paid more than $7,000. So all of those wages would be taxable because nobody was paid over $7,000. Right, so let's add those two amounts together. 88,100 times 0.006, 528.60. Questions about that one? This is the same thing. None of them were paid more than 700. this one looks fun. All right, in September, Manson Paint Corporation began operations in a state that requires new employers of one or more individuals to pay a state unemployment tax rate of 3.5% on the first $7,000 of wages. An analysis of the company's payroll for the year shows total wages paid of $177,610. The salaries of the president and vice president of the company were $20,000 and $15,000 respectively for the 4-month period, but there were no other employees who received wages in excess of $7,000 for the 4 months. Included in the total wages, okay, so this one's fun. This one's kind of going through a couple things that we haven't talked about yet. So amounts paid to a director for attending meetings are not subject to FUTA tax. They're not considered to be wages for FUTA taxes. Okay? But the salaries of the president and vice president would be considered, those are wages. They're salaries just like anybody else's. $6,300 were paid to the factory superintendent. Those are wages. And $2,000 in employee contributions to a cafeteria plan made on a pre-tax basis for both federal and state. All right, so total wages before that were $177,610. In addition to total wages of $177,610, a payment of $24.30 was made to Anderson Accounting Company for an audit it performed on the company's books in December. It doesn't make any difference to anything. That's just a business expense. Okay, that has nothing to do, that's not gonna reduce taxable payroll, and they're a contractor, so those weren't wages that were paid. That was just a payment to a vendor. So they're trying to throw things at you that don't make any difference. It's to keep you on your toes. All right. So the first thing we have to figure out is how much of these wages were taxable wages. Okay? So we're gonna start with the 177. We're gonna have to subtract some amounts here. The only people who made more than $7,000 during the year were the president and the vice president, right? Salaries of the president and the vice president of the company were $20,000 and $15,000 respectively. But the full $20,000 and $15,000 are included in this $177,610. So we've got to take out any amounts in excess of $7,000 for each of them. So all right, so we've got 13,000 here, right? We can do the math on that one. 20,000 minus the 7,000. So 13,000 and 8,000. So 21,000 of those salaries were over $7,000. Does everybody follow me there? All right. So we're going to subtract 21,000. So again, so the 20,000 minus 7,000, 13,000, and then we had the, what did I say, 15,000 minus 7,000 is 8,000. Added those two together, that's where I get my 21,000. Amounts in excess. All right. No other employees received wages in excess of $7,000 for the 4 months. Included in this were $900 paid to a director. We're going to take that out too. Also included in this were $2,000 in employee contributions to a cafeteria plan made on a pre-tax basis for both federal and state. Pretty sure those are pre-tax for food as well, but we'll find out if I'm right or wrong. Minus. 153,710. Times 0.006 for food and 922.26. Make sure that's right. Yep. So I took this times 0.006 for FUTA and SUTA. What's our tax rate? 3.5%. So where did I get there? 922.26. SUTA. $53.79.85. Questions on that one? Make sure you take out any of those payments that are pre-tax. Your book has a lot more details on which individual payments are pre-tax. For FUTA purposes, we just went through a few generally. All right, we will continue on Thursday. We'll take a look at a couple other things here. The experience rating system and the reserve ratio. I know you've got some homework problems on those as well. We'll go through those.